Okay, so this is our last teaching class for the semester. And um, so what we're going to do today is we're going to review homework number 4, complete chapter 9, and look as much as we can on chapter 11.
Okay.
So let's begin with um, a review of the homework. So the true and false section. Now, you're the only one in, but I see what I'll do is I'll stop at question 4 because I see that that's one that you got wrong. But
Yeah, I keep getting mixed up on that one.
yeah. So the I'll go through the answers and then I'll go back to question number 4
Okay.
because you're not the only one who um, had difficulty with that. So the answers are as follow: true or false. One is A. Two is A. Three is B. Four is B. Five is A. Six is A. Seven is A. Eight is B. Nine is B. 10 is A. 11 is A. And 12 is B. And so let me go back to question 4. Question 4 says, with respect to DSRs, debt service ratios, when calculating the monthly contribution of a credit card, we use a percentage of the outstanding credit card balance, usually 3 or 5%. Now remember, we don't use the credit card balance. We use what?
The limit.
The limit. So that's why that's false. Okay. Um, a lot of people overlook the word balance. So you have to read the questions carefully.
Mm-hmm.
Okay. So let's move on to multiple choice.
Just a minute. You said number one was 8?
Number one is A.
Oh, I thought it was 35%. I mean, and sorry. Yeah, I thought it was, yeah, 35. That's why I chose B.
Oh, you chose B. Okay.
Yeah.
Okay. But I had highlighted 4 because the ones that one person may have gone wrong. I'm not highlighting those tonight. But
Mm-hmm.
one where 2 or more people, and in with respect to question number 4,
Uh-huh.
I think at least 3 people. Uh,
Okay.
so that's why I'm highlighting the question 4.
Okay.
Okay. Um, but the TDSR is 45.
Okay.
GDSR, right? The
Mm-hmm.
gross or gross, that is the housing portion.
Uh-huh.
That is 35%.
Oh, okay. All right.
Okay. Um, yeah,
Thank you.
no problem. Okay, so let's move on to the multiple choice. Multiple choice. Um, I think, yeah, multiple choice. That was answered fairly well by just about everyone. I don't have any questions highlighted, so I'll just go through those questions. Um, but if you got any incorrect and you want to discuss them, we can discuss them.
Okay.
Okay. So one is E, two is B, three is A, four is B, five is D as in dog, six is A, seven is F as in frog, eight is D as in dog, nine is C, and 10 is B. Any questions with that?
No, sir.
Okay. All right, so we move on to section 3, fill in the blank. Um, Question 1, the missing information is the client's pool of assets less their liabilities. Okay, the client's pool of assets less their liabilities. Question 2, you can have any two of the following: existing loans or existing credit cards, life insurance policies, savings accounts, utility bills, equity buildup in property, college fees, any two of those. Again, existing loans, credit cards, life insurance policies, savings accounts, utility bills, equity built up in property, or college fees. Okay. So section 3, Sanchez is just joining or via Zoom. So section 3, question 3, the fill in the blank is servicing. Servicing. 4, the two missing items are easy to value and has stable value. So again, easy to value and has stable value. All right. So now question 3, question 5, section 3. The first blank is character. The first blank is character. The second blank is capacity or capability. Capacity or capability. The third is won't or can't pay. Won't or can't pay. And then the fourth one is has the financial resources to pay. Has the financial resources to pay. Any questions on that?
No, sir. I just missed the second box.
The second,
The second box I overlooked it, so I didn't have an answer in there.
oh, okay, that was blank. Okay,
Yes.
okay. One or two people had blanks in one or two of the spaces. Okay, so section 4 of the mock. Section 4 of the mock. Let's go through that case study type question. And this one is Hezekiah and Lottie Balfour. Hezekiah and Lottie Balfour. Oh, I have your paper here. Okay, so we're on section 4 now, the case study type question. Homework. Okay, so there were 3 things for us to do in this. The first was to complete the net worth statement, to state whether or not the net worth statement was positive or negative. And then the third was to calculate the TDSR using the spreadsheet provided. Okay. So Okay, so the case study, Hezekiah and Lottie Balfour. Hezekiah and Lottie Balfour need to borrow $35,000 in order to add an efficiency apartment onto their residence. They currently have a mortgage with Biff's Bank and have approached them to do the financing. The new loan would be in the form of a further charge or second mortgage, repayable over 19 years, and they will pay $348 monthly on it. They expect to get a minimum of $500 a month from renting out the efficiency apartment. Okay, so we are provided with a printout of the consumer loan or the car loan. We also provided with a printout of the residential um, mortgage, the mortgage loan, and from that we can see. Well, actually, let's go back to the just by way of information and review the late payment history. We see that they have a good um, payment history. There's only been twice late in the 1 to 30 day category. Um, so it never went two payments past due. Um, the a similar thing for the mortgage. There were two payments um, that were in between the 3 to 29 days. Um, in the first block, 3 to 14 days, it was three times late. 15 to 29 days, twice, but it never went in where it was two payments past due. Okay, so it never went into the 30 to 59 day category. And the year-to-date history, there are absolutely no late payments at all from 3 days and onwards. Now there could be some 1 or 2 days, but because the late date counting starts from three, anything 1 or 2 days will not register. Okay, so there may have been 1 or 2 payments, 1 or 2 days past due, but we're not told that, and that's not a part. That's not a part of the of the history that's captured by this particular bank. Okay, I think I see George is joining us by Zoom. Um, we are on we're reviewing the case study of the homework number 4, section 4, and we've just begun. Okay, so let's go back for those who've just joined us via Zoom. We, we were been asked to complete the net weight statement, to complete the TDSR spreadsheet. Well, first of all, to say whether or not the net weight statement is positive or negative. Okay, um, so we were given a blank. Oh, I was just going through and saying we provided. So we provided with the background information. We provided with the consumer loan for an new automobile printout, the printout of the mortgage account, a blank personal net weight statement, and also a blank TDSR statement. So let's begin completing the personal net weight statement. So the first item there is cash. Is there any cash?
Yes.
Yes, there's cash. Okay. So in the information given for the benefit of those on Zoom and also in the class, I have it on the board in blue ink, highlighted in blue ink. So among the other assets are $500 in savings account with RBC, $2,100 in savings account with Biff's Bank, and $937 on a checking account also with Biff's Bank. Okay, so we add the three of those together, right? Okay, and we get 3,537. $3,537. Okay. The next thing is stocks and bonds. Do they own any stocks or bonds or shares or whatever you call those?
Yes.
Those instruments? Okay. Yes. Okay. That's in the very next sentence after the cash. It says they also own $2,700 in BISX listed APD, that's Arawak Port Development Company Limited shares. And so that goes in the stocks and bonds column, right? Correct? Those of you on Zoom?
Yes.
Yes, okay. Are there any accounts receivable?
No.
No accounts receivable. Is there any uh, cash surrender value in life insurance policies?
Yes.
Yes, okay. So we're also given that information around about the middle of the page. Mr. and Mrs. or middle of the write-up, Mr. and Mrs. Balfour have a joint life policy with a face value of 325,000 and a current cash surrender value of 19,763. Now remember, the only thing that goes in the net worth statement is the cash surrender value. That is why they say CSV, cash surrender value, not the face value. They would only get the face value if one or both of them die. Okay? The only way they'll benefit from 325,000 is if one or both die, because this is a joint life policy. So it only takes it's a joint life policy. It means in both of their names, if one dies, uh, they'll get $325,000 or however it's set up. Because it may be set up where um, one gets one amount, one gets another amount if they die. But we're not concerned about that. What we're concerned about is that cash surrender value. Okay, so the cash surrender value is $19,763. So we put that in. Okay. Real estate. Do they own real estate?
Yes.
And what is the value of that real estate?
$644,500.
And where do we get the information?
That was from the um,
The loan statement.
yes.
Right. Another way to double check it. In the write-up, it says, upon completion of the apartment, the Balfour's residence will be valued at $679,500, and they're borrowing $35,000 to add the efficiency apartment. So if you subtract the 35,000 from the 679,500, that will give you your 644,500. Okay, so that's another way of double checking it because it's telling us because they're using that full $35,000 to add on the efficiency. So at the end, when that's completed, the value of the house will go up by 35,000. But now the statement of affairs, the current state of affairs, we're only showing what the house is valued currently. Okay, not the value adding on. Okay, so the current collateral security value is 644,500, and that's what goes in the personal net worth statement. Okay. All right. Um, Now we know they have an automobile because they have a loan, right? They have a loan for the automobile. Okay. Um, but do they have another automobile or other automobiles?
Yes. It says the cars are worth
Okay.
47,000.
Okay. So that third paragraph, the Balfours also have a car loan over one of their vehicles. The loan is being repaid over the counter. Collectively, the cars are worth 47,000 and are both comprehensively insured. So what we'll do is, since we've been given information for both cars, we will put that lump sum in there, 47,000. Now, if we, under normal circumstances, we would show them separately, or you could do them um, collectively. It depends on what your financial institution wants, because your financial institution, the statement of affairs, may only have a space for one. Okay.
Yeah, I just realized my cousin make an error, man. I was doing it separate, but I only put one.
No, that's fine because it's joint.
Yeah.
I mean,
Oh man.
it's collective, so it's 47. Collectively, they're worth 47,000. So you won't
Yeah.
you won't
Um,
use the current value. You won't use the current value from the statement. Okay, you won't use the current value from the statement, unless, of course, what you do is you subtract the current value from the 47,000, and that'll give you what the value of the other car is. But why give yourself extra weight? Okay, so in the exam, you could, if there are two cars just like we do cash, put them together. In the exam, you can put them together, or you can show them separately, separately or collectively. Okay, but in the exam, if it's given to you as a collective amount, put the collective amount, because remember now you don't want to give yourself any extra work unnecessarily, because you have a certain amount of time to complete the exam. Okay, so so if there's two autos, sometimes you show them separately, sometimes you show them combined. Okay, um, but like I say, for the sake of the exam, if it's given collectively, put it collectively. Okay, if it's separate, you could show it separate. Now with the cash, you have to add, because we were given three different cash, and we only have one section for cash. Okay. If they had three vehicles, you could probably use one of those others if you wished, and put in their car. 1989, 1992, or 2014 Lexus, or whatever it is. All right. Okay. So, speaking of other, what other assets do they have?
I think they have payments.
Okay. Well, let's before we get to the paintings, they have furnishings, right?
Yes.
Furnishings valued and insured at 52,000. Okay, so we put that in there. Okay, 52,000. And if you want to be diligent, you can put in the word where it says other, and the colon there means you should identify what it is. Okay, but like I said, um, you won't lose any points for not putting in the word furnishings there. I'm more concerned about the amount going in. Okay, so $52,000 in furnishings, and someone said something about art collection. Okay, so it says additionally they have modest art collection of paintings of various Bahamian artists, valued at 37,500 collectively. So you would slot that in there, 37,500. Okay, so yeah, 52,000 for your furniture, furniture or furnishings, and then 37,500 for art collection. Are there any other assets that we are provided with?
No.
No. Okay, so we'll total that. We get 807,000 flat, or even, as people say, 807,000 even. Okay. Okay, so let's move over to the liabilities. They don't pay rent because they're living in the house for which they're paying mortgage. Do they have credit cards? Yes, okay. And the write-up tells us there are two credit cards, one at this bank with a $5,000 limit and a nil balance, and the other at RBC with a limit of $2,000 and an $850 balance. Okay. So what amount goes into credit cards?
850, the outstanding balance.
Okay, so someone on Zoom is saying $850. In class, someone is saying 7,000. So why $850 dollars?
That's what's owing.
That's what owing, right? So while they have when you're looking at the personal net worth statement, you're looking at what is outstanding. Okay, so what is outstanding is nothing on one card and 850 on the other card. So we'll put $850 in there. Okay. Do they have a consumer loan?
Yes.
Yes, that's the auto. That's the car loan. Yes. Okay. And what is the amount that we put in there?
Yeah, 8,258.
Okay. So remember, we're doing net worth, so we're looking at what is outstanding. Okay. So, and we get that figure from the loan statement. Okay. So the loan statement says the current loan amount is 8,258. Okay. And we look at principal balance only. We don't add in the accrued interest. Because remember, it's like accounting. In accounting, you when you're doing assets and liabilities, you look at the principal amount outstanding. Okay. So we plug that in there. 8,258. Okay. There's a mortgage. And what amount do we put in there for the mortgage? 142,903.
142,903.
And we get that figure from the mortgage statement. Okay, the current loan amount, the principal balance, is 142,903. Okay, so we plug that in there. Are there any other liabilities that we are given?
No.
No. Okay, so we total it, and we get 152,011. Okay, $152,000, $152,011. Sorry, $152,011. So what we do is we put that over in our less total liabilities under the um, total assets, so we can subtract it, and we should get 6,554,989. $654,989. Is the net worth positive or negative?
Positive.
Positive, okay. Both on Zoom and in the class, that it is positive, okay. It's positive. Now, for those of you on Zoom, well, first of all, those in class, I've given them a sheet that says class exercise, which is the Balfours, okay? And we will continue to look at the Balfours to get some additional information on them. Okay, so the next thing we will look at for the Balfours would be the LPV. Oh, sorry. Oh, we need to go to the TDSR. Eh? Okay, sorry. I'm getting ahead of myself. Okay.
Mr. Archie, what I wanted to ask you real quick was
Sure.
with regards to the assets, so we do count furniture?
Yes, because that's the assets. That's an asset. That's one of the assets. Remember now, this is their personal net worth statement, their statement of affairs. This is their statement of affairs. This is that.
Because I was looking for that.
This is that middle. This is that middle section of the those loan applications that we talked about, that the financial information for the client, right? Remember, so we said the top, or there's a section that says demographics, then the financial information for the customer, which is the personal statement of affairs or net worth statement. And then we said a portion of his request, the actual request, and then the bank's decision, right? The bank doing the analysis, and then the bank actually saying whether or not it's approved or declined. Okay, so
Yeah,
yes,
no, I understand that portion where it fits in with regards to the structure. I was just I didn't know the furniture was considered an asset because
yes,
it's sort of tangible.
yes, it's tangible. It's something that they own. It's something that they own.
So all vehicles are asset as well. I mean, there are no.
All vehicles, any
That's how we doing it.
any tangible
Okay.
assets.
Okay.
So, yeah, so you have um and that's why the headings are there to show you auto, and they have auto twice in case they have more than one auto. Um, other some people have um, like sole proprietors. A construction worker may have tools, just construction tools. A straw vendor may have um, some of her supplies or her stationery.
And they would all be considered
Or
assets that
inventory.
can be
And
factored
those
into.
assets, yeah, those are
Yes.
assets because they own them.
Wow. Okay.
And, yeah. So um,
So
if
so the vehicle, whether it's insured or not, is still considered an asset.
it's an
Just
asset, yeah,
for the benefit of the class. All
yes.
right. All right.
Insured, the insurance on it has nothing to do with when you're looking at um, when a customer is completing their statement of their affairs, they are listing everything that they own. So, for example, if the Balfours had say a 20% interest in a store called Fancy Shoes, and that 20% ownership was worth $25,000, then you would put that in there because they own 25% in Fancy Shoes, 20% rather in Fancy Shoes, and the value is $25,000. So
Jewelry
whenever,
and all that is considered an asset as well.
yes, that's an asset.
I mean, wow,
Yes,
interesting. Oh,
yes,
okay, I didn't know that.
for the benefit of the class as well as in actuality. Because remember now, this is the customer's statement of affairs. Now you may say, in terms of when I want to take collateral security, um, in your assessment you may say they say they have $52,000 worth of furniture, but I think it's only really worth 40,000. So you may do your bank assessment of 40,000.
Yeah, that's my training was causing me. I
Okay,
gotta
but but
change my mind.
but I would not downgrade it because the write up says that it is also insured,
Right,
right?
because my argument would be like for the vehicle, right? Say it's not insured. Like they could crash it tomorrow and then they wouldn't have that asset no more. So it's a tangible asset. So that's something we normally wouldn't consider. So that's why I was a bit surprised we would count all vehicles, regardless of it being insured or not, as an asset.
Okay, well let's take that step by step. We are looking at them the 29th of August. Do they have that vehicle?
Yes, they do.
Yes, they do. Okay, so you include it. Now come the 30th, it is written off, and the write-off value is $500. Do they still own that vehicle?
Yeah, but the value is different now, eh? I mean, we
So
wouldn't
now
still
the
consider
value is
the
different.
first value.
The value is now different because it's written off. Okay, so it's like a house that is depreciated. So if these people come back to us, right? They come back to us next year. We don't we don't expect the automobiles to be worth $47,000 collectively. By depreciation, they'll probably be worth 38,000 or less. Okay, so the statement of affairs is a snapshot, is a picture snapshot in one point in time. So when they sitting before you, that's their current position. Okay, whether that car is insured or not, whether that house is insured or not, whether that furniture is insured or not, whether the art collection is insured or not, they own it. They own it.
No, that's understood. I know how to approach it.
Yeah. Now, so yeah, okay. So valid question. Because because not just for the class, but also in real life when you are doing assessments. Well, actually, when you're collecting the data from the customer, you have to reflect their statement of affairs. Because remember now, they are signing off on the statement of affairs. So they're saying that's what it's valued. You have to take their word for it. Now, however, some banks, when they do the assessment, they may downgrade it. Right? Okay. All right, we have a student joining us. Yes, okay. So we are doing the last question, the case study question of homework. Yes.
Yeah, I realized I got that wrong.
Okay. So hold on to this because we're gonna do some additional work on Balfour, the Balfours. Okay. So mono, right? And then there's your homework and some past homeworks. Hold on to you. Okay. Hold on to that. And that's the homework and some past homeworks. Okay. Sorry about that, folks. All right, so we've completed the net weight statement. Let's complete, we said it's positive. So let's complete the TDSR. Okay. So what is the first salary? How do we put that in? You make $750 a week. Sorry?
Times that by 52 and divided by 12.
Okay, very good. And that becomes
3,250 monthly.
3,250 monthly. Okay. And we use 100% of it. And so the adjusted amount, and remember the adjusted amount is the amount that we, the financial institution, the adjusted amount is that we, the financial institution, we assess, we use that portion in calculating the TDSR. Okay. So bonus, Hezekiah makes a bonus of $6,000 per annum. How do we deal with that? 6,000 divided by 12, yes. Okay, so we get 500, and we use 50% of bonuses. So that's $250. Okay. What about Lottie? Lottie makes $5,200 a month salary income. How do we treat that? So we put 5,200 in the monthly amount. We use 100% of it, so the adjusted amount is the same. Okay, what about rent from the efficiency that they are going to add on? Now remember, we are calculating TDSR. This is a calculation that we are doing as a bank. So they project to get $500 a month from this efficiency. So we using that to determine their debt service ratio.
500 in the monthly amount, and we're
500 in the monthly amount.
using 50% of it.
We use 50% of it, and so that's $250. Very good. And then we add it up, and we get $8,950. Okay. So the mortgage is $1,140 per month. How do we deal with that in the monthly amount and adjusted amount? The same, yes, $1,140. So that's both in the monthly amount and the adjusted column. The proposed further charge, okay, $348 per month. And so the adjusted amount is $348. The car loan, $725 in both columns, yes. Okay, so credit cards. We have one of the $5,000 limit, a nil owing. What amount do we put in the monthly amount? Put
5% of the 5,000.
We use 5%. To the bottom it says use 5%. So 5% is $250. Okay, so that's $250. Again, we are, remember, in the net worth statement, we use the balance, right, of the credit card. But in the when we are calculating, because that's a customer. Now we are calculating, because the TDSR, we are calculating, right? We are calculating. So we work it on the limit, and that's because they can go up to that limit at any point in time, regardless of what the current balance is. Okay, just want to make sure you're all on the same page with that. So it's $250. Royal Bank credit card, 5% of is $100.
Of 2,000.
Okay. So 5% of $2,000, the limit. Okay, because we're doing the assessment. Okay, so we add them up, and it comes to 2,563. Okay. What is the TDSR?
29%.
29% rounded. 29% rounded. So you can have 28.64 or 28.6, or you have to round it up, 29. Okay, because it's anything 0.5 and above, you round up. You don't round down. Okay. If it's 0.4 or below, you round down. Okay. So 28.64 or 28.6 or 29% rounded up. Okay. Okay, so let's look at the LPV. Sorry?
0.4 round up.
If it's 0.5 or higher, you round it up. Okay, that's the min mark. 0.5 up, you round up. Okay, 0.4 and below, you round down. It's similar to how they do now with the 1 cents. Okay, okay, so if it's 0.4, they round it down in the food store. If it's 0.5 and above, they round it up. Okay, so what is the current mortgage LPV or LTV ratio? Okay, so here's our equation. LPC calculation is the loan amount divided by the asset cost or value, multiplied by 100, gives you the LPC or LPV. So where do we get the loan amount?
On the mortgage statement.
The mortgage statement. Okay. Okay. The extra page I gave you. Okay, so just flip to the the relative page where it says LTV. Is it page 7? Yeah. Okay, so those in the class have copies of BAL 4 that have the extra pages on it. For those of you on Zoom, just write the notes down, the answers down on a separate piece of paper. In any event, the PowerPoint presentation will be sent after class. Okay? So LPC, LPV, loan amount, we get that from the statement, which is 142,903. So that's our numerator, our top number. And now we need the asset cost or value. Where do we get that from? From the bank statement, eh? Or you can get it from the net worth statement, right? Okay. So you have 644,500, that's our denominator. Okay, so 142,903 divided by $644,500 gives us 22.17 or 22%. Sorry, 22.17 or 22.2 or 22% rounded down. Okay, I know it's not on the screen, but you can also use 22%. Okay, one of those three. 22.17 or 22.2 or 22 flat percent. Any questions on that? So let's now look at the current equity. Okay, so the last three things we were looking at as the Balfours, and as you can see, we intend to complete this similar to how we did our in-class case study with the rules, right? So what is the current equity? Okay, here's our equation. The current value less any current encumbrances gives us the current equity. Okay. Now, in this instance, the only encumbrance that we're aware of is the mortgage. Okay. So, so the current value is, where do we get the current value from? The mortgage statement. So that's 644,500 as our current value. Where do we get our encumbrance or current loan amount? From the statement as well. Okay. So that's the principal amount, 142,903. Okay. And so we have the two that we need now. So we have our current value less the current encumbrance, which is the mortgage, and that gives us 501,597. That's the current equity. Okay. So they have almost $502,000 in equity, which is very good. Okay, the equity position is very good. But I mean, you can see from the loan as a percentage of the cost. The loan is only 22%, right? So 22 from that is what? That's 78. So 78%. They have 70%, 78% should equate to the 501,597. If you wanted to do further calculations. Okay. So again, we could get those from the statement, or we could get those from the bank statement, or we could get it from the personal net worth statement. Okay. Would you grant this loan to the Balfours? Yes or no? Yes. Okay. So I didn't hear anyone from online, but in-house is unanimous yes. So since you would grant this loan, since you grant this loan to the Balfours, now it's time to support your answer. So using comparative or credit C's. Okay,
They're good paying customers.
so character under under Campari as well as parentheses characters for both. Okay, so first of all we'll put when we're doing our screen, because I think for those here you'll see this. Oh no, it says character count. What does yours say? Oh, it has blank dots, right? Okay, so you'll either um use comparative. So you'll put the first one will be character, okay? Because characters for both. Sorry, yeah, that's for you. That's for you to keep. For those in here, that's for you to keep. Yes. Okay. For those in class, the handouts are for you to keep. Okay. So you start with character. Okay. So someone said what they someone saying about how they pay their loans or something like that.
They're good paying customers. They pay on time.
Okay. So they're good paying customers. Okay. Um, what about anything else we can say about the character? Now bear in mind, I'm asking for more than one, but when you come to answer these questions, right? Um, for those who are in class and have the script, I'll read it for the benefit of those of you in Zoom. It says, using the three key factors, either Campari method or the credit C's method, assessing credit, briefly outline your reasons for approving or declining the application. And then in brackets next to it, it says 3 points total. Okay. So if it's 3 points total, don't write a whole bunch of stuff on character and leave out stuff for capacity or ability or insurance or whatever. Unless, of course, there's nothing to say on one of the other ones. Okay. So there's 3 points awarded, which means you got to make 3 statements. You got to make 3 valid reasons. Okay. So the three valid reasons, we already said one, that they pay the accounts very well. Okay. Um, so let's move on to capacity or ability. If it's in the TDSR, you want to be a little bit more specific than that. Okay, TDSR is what? The percentage. The percentage is what? The maximum is what? 45%, right? TDSR, the maximum is 45%. What is their TDSR at?
28.
28 point something.
29.
It is 29. Okay. So 29, I would say that's
They
doggone
can
good, eh?
pay comfortably.
Okay. So they could comfortably afford this payment. Because remember now, this 29 includes that $348 payment for the further charge. Okay. So 29 from 45, that's like 16, right? Okay. So they got 16% to play with. Okay. So if y'all want to give them another loan to go on vacation, y'all go ahead. Make sure to fill up your quota, you know. Um, okay, so they have the capacity or the ability to comfortably meet the payments, because their TDSR is 29%, versus the maximum of 45, right? Okay. What about insurance or collateral? What could we say about the insurance or collateral?
You have some good equity.
Okay, they have good equity. Let's kind of like use some let's be scientific, because that's subjective, right? But you want to combine some science in there. So like we talked about the 29%, you know, for the capacity or ability. You want to talk about um, talk about the LPV or talk about the equity one or the other, right? Or use both in conjunction, right? So you probably want to say they have very healthy equity in that they only owe 142 or 143,000 if you want to round it off against the residents, which is valued at 644.5 thousand, right? Okay, so
Expenditures.
sorry.
You got people that spend less expenditures, as you call it.
What you call them spendthrifts? People who spend a lot of spendthrifts.
See, if a parent, they're not chronic, they're not spending a lot of cash. Because they have a credit card of 5,000 would be done.
Right.
$2,000 in a week.
Right. So that talking about how they spend their money, vis-a-vis their credit card. Someone in the class is saying that you know they're not careless with their money. They're frugal with their money, right? They're not spendthrifts because when you look at one credit card has a nil balance, and the other one has a fairly medium to low balance. Okay, and that would be part of character. If you want to make that point for character, that you're talking about their character, their propensity to do a certain thing. Okay, so here are some pet answers. So character, the Balfours pay their debts very well. This is evidence of good character, which is essential when considering granting a loan. Again, you don't have to. I think Carrie asked about this in a previous class. You have to say this is evidence of good character. It's essential when considering or granting a loan. For the sake of the class, in this class, you don't have to, but certainly in the workplace, you would want to say that this is because you're not going to have it saying character and then you write down because you're going to say the Balfours pay their debts very well. This is evidence of good character. So it's showing that you are addressing character. Okay. Um, so when it comes to capacity, well, let me go back to that. So again, for the exam or for the sake of this class, you really only need to say the Balfours pay their debts very well, right? And if you want to elaborate as evidence of no late payments or very few late payments, or as evidence from the bank statements provided, I mean, it's up to you. But the main point is the Balfours pay their debts very well. You got 1 point. Okay. Capacity, TDSR, including the proposed loan, is 29% rounded. They therefore have the capacity, ability to comfortably meet the payments and take on additional debt. Again, the second sentence is something that you would use in the workplace to demonstrate that you are commenting on the ability, or in this case, capacity, because we're using capacity, using credit Cs. Okay, and then collateral. The Balfours have very healthy equity in that they only owe 142 odd against their residence, which is currently valued at over $600,000. Additionally, it is located in a subdivision where residences are valued in excess of $1 million. The LPV is 22%. Okay, so basically, you just want to talk about they have very healthy equity in that they only owe XYZ versus the value. Okay, so you want to, particularly with capacity and collateral, you want to add in some science in there. Okay, some numbers. Okay, so all right, and then of course, if you're using Campari, you'll just put in character ability insurance, and then it's the same thing, right? Or sometimes we say in the bottom, it's the same difference, right? Okay. Okay, so for Hezekiah and Lottie Balfour, we've completed them the same way that we have completed Martin and Sherry rule. So you have an example of two case studies, which would be good for you to review in terms of preparing for the final exam, right? These two are complete. So we've completed the net weight statement, we've completed the debt service ratio statement, the current mortgage LTV, current equity. We've answered the question, would you grant the loan? We've supported our answer using a pari or credit Cs. We've also said whether or not the net weight was positive on the net weight of the statement was positive or negative. Okay, so any questions on that? Okay. All right. Well, we'll take a quick look at these again on Thursday's class, right? Just to make sure that everyone is on the same page. All righty. We'll go through those very quickly and probably look at one or two others. All right, so let's complete chapter 9. So let's put those away and go to page 55. Sorry, not 55. We go to page 54 in our textbooks. Before in our textbooks. All right. So previously, we looked at promissory note of debenture, legal mortgage, chattel mortgage, pledge, hypothecation, lien, authority to hold bank balances, and the hypothecation of shares or assignment of shares. Okay. So tonight, we can look at documents, the storage, management, and control of them, in particular, the credit and collateral security files. And we'll look at monitoring and controlling accounts and some reports that, some monitoring and controlling account reports that we will get either daily, weekly, monthly, whatever. Okay. So, so page 54, the first paragraph, during the loan approval, sorry, page 54, you don't have page 54 in your book? Oh, you missing page 54, okay, all righty, okay, I'll have to get that for you, okay? You have page 54? Okay, anyone else is missing page 53 in their books, their workbook? Sorry, 54, missing page 54? Okay.
No, sir.
Alrighty. Okay, so one student, we have to get page 54 for one student. Okay. Okay, well, I'll read in any event. So the heading says, discuss storage, management, and control of active security dossiers. That's a old, or dossiers. That's a old term used for files. Okay. So during the loan approval, the manager or credit officer would list in detail all security items that will be taken to support the transaction. Most banks would require a separate security schedule to be prepared along with the loan application form. So you have the loan application form, and then you'll have the list of the documents. If you go back to when we were looking at the loan application, it was the mortgage one for Fidelity. They had a tick list on the assessment form on the back page, right? The items. Okay, so they made it very easy for their loan officers. Some banks will just have a separate tick sheet that you would add to the loan application with the various items to be collected as documents either for the loan and or documents in support of it that you'll take as collateral security. Okay. The loan application form, invoices, financial statements, business plan, and other supporting documentations will be placed in the credit file along with a copy of the security schedule. The original security schedule, along with all original security documents, will be placed on a separate security file. Okay, so we have two files: the credit file and the collateral security file, right? So the credit file is your everyday working file. So that is why you will have a copy of that schedule of documents. Okay. In the working file, you'll also have like correspondence to and from the client. Okay, so if you send out a letter to the client sent a letter to you and you're responding to the client, those will be in your credit file or your working file, that's your everyday file. The collateral security file is the one where you hold the original documentation. Okay, so you'll have the approved loan application, the original mortgage, or it's going to take some time before the original mortgage comes back to the registry. So you'll definitely have the original receipt from the registry showing where it was lodged. So that original document would be in the collateral security file. Insurance policy or policies, whether or not they're life insurance policies or homeowners insurance policies or car insurance policies, they will be in the collateral security file. Okay. So the credit file is typically stored in locked cabinets within the credit department or the loan department, and in some cases in a book vault. Okay, so, and of course we file those alphabetically according to the customer's last name. Some banks will have it by customer number. Okay, but for most of us in retail banking here in the Bahamas, it'll be filed alphabetically by the customer's last name. Okay. Banks make it a mandatory requirement to store security files either in the main cash vault or a separate proper vault. This is because security files and documents therein represents the bank's possible claim against the customer's assets, and at the very minimum, the bank's safekeeping of those assets. Okay, so and it's normally under dual control. Okay, so collateral security files are normally under dual control. You won't have, so whereas the credit file, you may have an administrative assistant or a clerk designated to deal with those. So you'll if you get in the file, you sign in, sign out for the file, and it goes back into the book room or the book vault, whatever it is. That's controlled by basically one person. In some instances, just about anybody could go in the book room and pull out a credit file. Okay, unless of course you've taken measures that the administrative assistant or the clerk who you assigned has that door locked, access to the files or the filing cabinets or the book vault. Okay, so unless that's locked by the person who you have charged, sign in, sign out, that's really under single control, or anybody could go in there, right? Now, whereas with the collateral security, you have dual control. And the reason for that is to minimize any hanky-panky, anybody doing something untoward with the document. So you have two people. Okay, so it's either two keys, and you have a top key and a bottom key, or it's by combination, top combination, bottom combination. Okay, or if it's swipe card, it's two people to do their swipe cards in the designated areas. Okay, but it's under dual control. That is the security file. Okay. Any questions on that? Okay. So brief. I think I touched briefly on the commitment letter that you're saying discuss the role of a facility letter or commitment letter. Customers' acknowledgement of the credit terms, margins, covenants, including required collateral security. When a loan is approved, you would issue what is called a commitment letter or facility letter. Okay. Some banks call it facility letter, some call it a commitment letter. Some use one when they issue it, so they'll call it, this is our facility letter. Once it's signed by the customer, they change the word to commitment letter because the customer is committed. Okay. But either one is used interchangeably. Okay. Facility letter, commitment letter. What it does is it outlines all the terms and conditions and covenants of the loan. So it'll say the bank is pleased to provide financing in the amount of such and such for the purpose of uh, your business investment, starting your business or whatever it is, or buying a home or getting a vacant lot. The terms and conditions are as follows. So they'll say what the percentage, what the interest rate is, what the term, how long it's going to be, either in months or years, any collateral security that is required, such as if they can take a chattel mortgage or a mortgage, or they could take a debenture. Um, where there's any supporting documents like life insurance or car insurance, house insurance, those type of things. So it'll outline those kind of things, and the customer, there's a section to the bottom for the customer to acknowledge receipt and date it. Okay, so that's in brief. That's your commitment or facility letter. Okay. So it says discuss the role of the credit file and credit. Okay, we talked about that. So let's move on to page 55. Monitoring and controlling control reports. Okay. So top of the page it says, in order to effectively monitor and control accounts, bankers must, one, review daily excess reports, periodic arrears reports, margins reports. We can just list the reports first and then we'll talk about them a little bit later on. Okay. Examine frequent encroachments or temporary increases to credit facilities. Conduct testing of covenants. Conduct a comparison of actual against the projected financials. Identify any deterioration in cash flows or decrease in security value. Any change or changes in company management. Any negative publicity that the business experienced or is experiencing, and any other material adverse change to the particular business or businesses under review or customers under review. Carry out periodic site visits and spot check any inventory, and this is for business accounts. Take notice of passage of any new laws, legislation affecting the industry, any new entrants into that industry. So if you have a big food chain coming in, and Rupert Roberts is your customer, how is XYZ food store that's a big conglomerate, they have 50 food chains they will set up in the Bahamas, how are they going to impact Rupert Roberts, who's your client, right? Super value quality markets, right? Increase marketing strategies from competition or negative client publicity. So did your client dump a bunch of, or let's say, okay, so let's say, for example, an oil company, right? And let's say Sun Oil, their tanker turned over and all the oil from the tanker spill in the road. And it caused a massive cleanup before it went or penetrated the water table. Okay, so that's kind of like any negative client publicity. Okay, or In the case of an individual, you may see where the individual may have been charged before the courts for assault. You say, what? Boy, Mr. Nordich was charged for assault. Um, so you got to watch that carefully because if I'm convicted, that can affect how your credit account, the loan that you gave me is paid, right? Because even if you have salary deduction, um, I get convicted, I ain't working no more. Okay, so it has implications. All right. So reasons for monitoring and controlling. The ongoing monitoring and controlling of accounts helps to identify, prevent, and minimize potential risk and losses that might occur due to a material adverse change in the affairs of the borrower. Okay? Additionally, effective monitoring and controlling of accounts serve to improve the quality of the loan portfolio, that is the asset quality, and provide training to lenders where necessary. Thirdly, the monitoring of accounts, for example, covenants report and annual credit reviews, also help to identify whether companies are performing financially well, and where applicable, identify additional sales potential for the bank. Okay, so those of you on the positive side, those of you who have your quotas, if you have um, a business customer and they're performing well, you want to look for other areas where you can probably offer them finance, right? Or some other service. Okay, so if they're currently now only having cash sales, okay, and you have this new point of sale machine that came up, and particularly I see a lot of them still, a lot of these companies, businesses still using them ones that connected by wire. Um, they have these now remote ones that are portable, so you can walk around and no connection, right? You just charge it up and go, right? Charge it up overnight and go. Um, so maybe you can offer them uh, updated machines, or if they're only doing cash sales, offer them that service where they can now accept credit and debit cards, right? Um, right. And any questions on that before we look at the actual report types? Okay, so monitoring and controlling reports. The first one on our list is daily excess report. Okay, daily excess report. What is the daily excess report? Okay, you may have, for example, exception reports. And on those exception reports, they will highlight customers who have frequent encroachments. So let's say you're looking at checking accounts. Okay, so you're looking at the exception report for checking accounts, and you'll see a customer A went overdrawn, but customer A does not have uh, an overdraft facility, or customer B has a credit facility, but it's only for $1,000, and they went over $1,100, so they encroached it by $100. Okay, so the exception report um, um, where you're monitoring, in this instance, over checking accounts or current accounts, right, will help you identify those with limits and those without limits, and where they are encroaching. Those who go overdrawn without a limit and those who go over the limit. Okay, and the exception report may even be used to make payment decisions. Okay, are we going to pay these or not pay these? And that would be based on your experience with that customer. Okay, and it may be that you have to call the client, or you may just say, something, you went over, too bad, too sad. I return. Okay, so you get a return check. Okay, there are also suspense account reports, such as adjustment suspense accounts. So what happens is if you have, for example, some money came in for customer, but it doesn't have the correct account number on it. One or two more of the digits are off. And so you put it to a suspense account until you are able to locate the customer. Normally, the suspense account should not have that entry on it for more than 1 day. So within 24 hours, it should be reversed out of the suspense account and put to the proper customer's account, or return it to sender, or exceptionally get the approval from financial control to do further investigation or call. But generally speaking, on your suspense accounts, for something like that, it should not be on the account for more than a day. Okay, because you want to reverse it right away. Any question on that? Okay, margins report. This is one that relates to your interest rate. Interest rates is an interest rate report. And this is to ensure that the correct interest rate is being charged on the loan. So it'll have your different loan types. So if you have, mortgages, so people who are dealing with mortgages, look at mortgages. People who deal with consumer loans, deal with consumer loans. Or if you have both consumer loans and mortgages as a loan officer, you'll be looking at both sections of that report as it relates to your portfolio. Okay, so and under each one of them, it will be separate. So also overdraft accounts. So current accounts will also be in your margins reports, because you want to make sure that those overdrawn accounts, those overdraft accounts, are attracting the right interest rate. Okay, so and let me deal with that one first, with the overdrawn accounts. So if the customer has a marked limit, okay, they have an approved limit of $1,000, okay, and the interest rate on that's supposed to be 10%. You want to make sure that on the report it's showing 10% and not 12 or not 8, right? If a customer does not have a limit and they go withdrawn, okay, their interest rate should not be 10%. Usually the interest rate is higher because they don't have a marked limit, okay? And in that instance, they may attract an interest rate of, say, 15%, okay? So if you're saying that they are marked for a limit, interest rate of 10%, the same as what you give the customers who have an agreed limit, then you need to deal with that, okay? Because they should not be paying the 10%. They should be paying the high interest rate, whether it's 11, 12, 13, 14, 15, 16%, all right? So that's the checking accounts or current accounts. So for mortgages, you have your different types of mortgages. So you have your residential mortgages and you have your commercial mortgages, okay? And under residential mortgages, you have different types, okay? So you may have someone who has single family, which may be a lower interest rate than a duplex or triplex, okay, or condo, right? You may have equity loans where people borrow against equity, and sometimes those are higher, depending on the purpose. The interest rate on those are higher. Okay, so you want to make sure, and a similar thing with your commercial loans. Your commercial loans, they have different categories based on the risk. So if it's a retail store, it may have, your retail stores may have a certain interest rate. If it's a manufacturing plant, it may, like Coca-Cola, they may have a different rate, okay, interest rate. So the whole point is you want to look at that margins report and make sure that your the credit facilities, whether they're current accounts, whether they're consumer loans or mortgage loans or commercial loans, as the case may be, that they are attracting the proper interest rates, because that affects your margin, your profit. Okay. Then you have periodic arrears reports. Okay, this is where you deal with the loans that are in arrears, that are past due, your delinquency or non-performing reports. That is 1 day late, or in some cases, if you don't start until 3 days, it'll show whenever your start date is, right? So periodic arrears reports, although I would recommend that the periodic reports that they would start at 1, okay? Um, even if your threshold is you start at 3 or 5, right? In terms of when you actively deal with them with your collections, right? Because remember, in the early going off, your today, in the early going off, your branches are going to be dealing with them at least first day 2 or 3 before they go into collections, right? So because they have because what they want to do is they want to look to see if it's an internal problem, right? Whether or not we got the money but it went to the wrong account, okay? Um, and then you resolve it very quickly, or whether or not um, uh, there's no money that came in, but you need to call the customer and say, hey, um, when you can bring in the payment, that is for those customers who are paying over the counter, okay? And then you document, customers say they'll bring in the payment in 3 days' time. So by the time, if at day 3 it now goes to collections department, collections will then see where the branch, right, made their note that the customer said they'll pay in 3 days' time or 5 days' time. And so then they will, if they don't see that payment on day 3 or day 5, whenever the promise is made, then they will then take up and call the client. That way, you have it documented from point A to point B, regardless of who's dealing with it, at what point in time, who's dealing with it. Okay, so and like I said, my preference is that in the first couple of days, the branches deal with it um, to make sure that they're responsible. Okay, and um, and collections will also get that same report because they'll be able to see when it went 1 day past due, 2 day past due on the third day, and when they get it and there's no activity by the branch, the officer in that particular branch, then they can take a note, and if that's a habit by that officer, then it can be addressed by management, the managerial level. Okay, so the manager of the collections department will have a word with the manager in the branch or of loans and say, you know, Mr. Nordage is not following his accounts 1 to 3 days, right? And so the manager will have to have that conversation with Mr. Nordage. Okay, so and then of course they'll be characterized by 30-day, 60-day, 90-day, and over. Okay, again, um, those categories are important because um, they coincide with reporting requirements to the central bank for those similar periods. Okay, so that's for periodic arrears reports, collateral security, compliance, monitoring. Um, this deals with your covenants, your collateral security report. If it'll show out of order or expired items. So if there's a covenant that has not been met yet on a particular loan, um, that will be seen by whoever is charged with following up on that report. More than likely, that's your administration department. Although your credit risk people are keeping a good eye on it as well. Okay, because remember, that type of monitoring and controlling credit risk has a secondary um, responsibility to check, because if those covenants or collateral security are out, it presents a credit risk to the bank. Okay, so a true credit risk department, right, or credit risk manager will be looking at that. Okay, um, and so and then it's an ongoing basis, not just for individual items that are outstanding, but on an ongoing basis, like life insurances, car insurances, building insurances, contents insurances, right? Um, for businesses as well as individuals. So it'll show certain that it'll give like a tickler message saying, this one expires next month, this expires in 3 months' time, etc. To give you a head start um, that okay, this one expiring the end of this month or the end of next month. I need to, follow up with the officer or follow up with the customer, as the case may be, for insurance. Okay, and it also shows expired items. Okay, so if a life insurance has expired, whether it's joint or single, it'll show that as well. All right. Okay, so where are we now? Monitoring and reporting, compliance and non-compliance. Some of the reports are risk rating reports on your client's accounts, which include both your deposit and your credit accounts. Um, Politically exposed persons, that's PEPs, etc. So this is where like annual reviews, you want to make sure again your risk, the particular credit is properly risk rated. If there's a change that needs to be made, so like if there's an annual review of an account that comes up, um, is that credit risk rating, does it have the same risk rating, or does it need to change? It goes up or down? Okay. Um, Politically exposed persons, regardless of in the facility they have, even if it's just a savings account, those persons have to be annually reviewed. Okay, and you have you have to address PEPs every year. You have to um, review PEPs. Okay? Annual credit review reports. Again, this kind of ties in with the risk rating reports. You will, when you're doing your annual credit review, you will be using your credit risk rating reports. Okay, so that is overdrafts, commercial loans, and like I said, PEPs will be reviewed or renewed annually. Portfolios size stratification report. This is a listing of all accounts by balance or exposure size. So, for example, um, you may say counts 20,000 and above, 50,000 above, 100,000 above, 500,000 above. Okay, that kind of thing. Okay, so it'll show you the portfolio by size. Okay, and again, it's also used by credit risk as well. Credit risk department or credit risk manager, depending on the size of your organization, you may have a department or you may have an individual who deals with credit risk. They would look at those reports, review those reports to see where how many of these very large accounts we have, or how many very small accounts, and that type of thing. Okay, and also how they're performing. Okay, so 50% of our accounts that are 1 million above are not performing well or performing mediocre. So then you may want to say, okay, well, we need to zoom in on those and see if they fall in any one particular category, right? So it might be is it retail or is it manufacturing? If it's manufacturing, okay, then you may say, okay, those are more risky, so we can stay away from the manufacturing ones and look more to the retail. So these reports help us make a lot of decisions in the bank. Okay? And then, of course, managing arrears reports. A lot of times, now these these are not generated. In some instances, these are kind of like automated. So, but it will document calls, system generated past due notices, formal letters of demand, collection, repossession, foreclosure, respect to delinquency, well, all your delinquency accounts, those that are non-performing as well as those that are performing, any problem loans that you want to, or any watch list accounts, so that is accounts you want to just watch. So, for example, PEPs would be, regardless of, even if they're performing well, PEPs would be on your watch list because the nature of them, the politically exposed people, will be on your watch list. Okay. And particularly if certain things are happening in your country with regard to the particular where that PEP may be involved. Okay, so if let's say you have national security, and so you have the permanent secretary from national security there. Okay, um, and there's a large contract going out for, let's take for example, like what's happening with the prison. Okay? It's supposed to be this multi-million-dollar extension or new facility, right? Okay, so you may find that the PEP's, the permanent secretary's brother, may have been granted the contract. Okay, so you want to watch what is happening with the permanent secretary's account in your, okay, whether or not um, you see some large sums of money start to filter in there and whatnot. So that's why PEPs would be on your watch list. Okay. All right. Any questions on reports? Because that concludes chapter 9. Okay. So we've looked at various documents used. We've looked at storage and management and control of documents, credit files, security files, and we've talked a little bit about monitoring and controlling of accounts and the various reports. Okay. Any questions before I move on to chapter 11? Chapter 11. Well, one of my Asian high school teachers used to say 11. 11. So here we go to chapter 11. When things go wrong, managing delinquency. Okay. So one of the first things you want to do is you want to determine the origination of the problem. And I alluded to that when I was talking to reports. Is it an internal matter or an external matter? Okay. Internal means something went wrong in the bank. Okay. If it's an administrative problem. So determining if the problem is internal, administrative, bank's fault, or is it external? Is it the customer, something to do with the customer, the economy, or nature? So like how we had Dorian, okay, and then we had the pandemic, and I had him talking about this new variant of COVID, and some people saying they could be implementing some of the restrictions September, but I'm hearing more mid-October, at least in the US. So who knows? But we need to follow it carefully and make sure that uh, um, we take the necessary precautions as financial institutions. Okay, having gone through Dorian, having gone through COVID, we have two scenarios that banks had to work um, through in dealing with clients. So we had it with wipeouts where people lost income or whatever it is, and then we had the shutdowns when you couldn't operate your business. Again, that's just for extended periods of time, 18 months a minimum. right? So, so we're saying if it's internal, resolve it quickly. Again, remember what I said about the suspense account reports, the that adjustment of suspense. If a payment comes in wrong customer name or number, it doesn't, you have to wait till you make sure that you have the right name or right number, and so do your investigation as required. Get that within 24 hours. Okay. If external, determine whether the problem is short term or long term. That is whether it's temporary or permanent. Okay. And then the implications if it's temporary or permanent. If it's temporary, well, of course, you kind of work with the customer. If it's going to be a permanent situation, then you got to do what you got to do. Okay. Um, so, which if you have collateral security, you call in the collateral security, or you go after any other assets that the client have, which may in turn legal action. Okay. I have a chart. It's not a part. I don't think it's a part of your. It's not a part of your um, book. I don't think. The chart on the screen is that's not in your books, right?
Mm.
No. Okay. All right. Okay. So this is just for information purposes, right? You see the cause for delinquency, um, and their columns. The next screen shows the next screen shows whether it's an internal problem or external problem. Then it tells you where the mistake was made. Was it made at the beginning when the loan was initially granted or reviewed, submitted, or was it made after the loan was drawn down? That is after it was approved. Okay, so you'll get this in the PowerPoint presentation. You can review it at your discretion. It's not going to be a part of the exam. Okay, so it's only just there for information purposes. Okay. So again, remember we talked about ability or capacity. We talked about uh, the customers, the cannot pay and the will not pay. Remember you did that chart? Okay. So the cannot pay is it temporary versus permanent? This is just expanding on one of the previous slides. If temporary, explore workout solutions. If permanent, and this is a good customer, but now on hard times, consider ways to ease the burden if you could, but don't delay the inevitable. Okay? Even if they're a good customer, they've been a good customer in the past, if you just got to do what you got to do sometimes. Okay? It's just one of those things. Okay? The will not pay customer, do not waste your time. Proceed to collect. Okay? You have customers, different types of customers. There'll be them who will give you all the excuses, right? They got one excuse after the next. I remember one man, um, his daddy, once he died 7 times, right? Until the final time, we actually see the notice in the newspaper that his father passed. you know?
Somebody called to check when I was she was burning a good fish right on my father just fought.
Oh yeah. I can see. This this particular customer, I think he worked at Patelco at the time. Now my mind is on. He used to go into Patelco, clock in, and then he'd jump in his taxi and go drive his taxi. Then clock out. Or he'll have someone clock in for him and clock out. Right? Um, he was also something in the church, so he was getting a stipend from the church. Right? So he had his BTC money, and BTC was one of the BTC and BEC back in the day were two of the most highly paid government departments, right? staff they were paid, when you consider their pay and other government departments and ministries, they were the two highest paid. Okay. Sorry?
Because
Because you still have a lot of those people there, right? The tail end, a lot of those people. So, but he would always, he need to release, if we could release the part of his payment, because he got a bury his daddy, take care of him, right? And so then when a new officer, if a new officer came and he realized that there was a new officer, he came with that same story. Okay. And see, this is why it is important to document and keep stuff in the credit in your credit file, in your working file. And then you can look back and see, well, we just we just waive a payment for you because your daddy died 3 months ago or last year or whatever the case may be, right? And then I remember his father actually did pass, and he did not come to the branch. He went straight to head office to the managing director, right? Because by that time he knew he wasn't buying his story, right? Um, and he provided the managing director with um, the newspaper clipping, right? So the managing director said, release the money, right? Say, well, at least now we know he can't come back using that excuse. Okay. So, okay. So the do not pay. So you have those people who have a lot of excuses. They will keep promising, keep promising, keep promising, keep promising. Okay. And then you have the terrorists, right? You come walk in my job, I'll bust you. Da, 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 da. You come trying to take my car, what I could do with you, and blah 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 blah. You wish you wasn't born. So those are those are the terrorists. Okay, you'll never get anywhere with them, and there's some others, but those are the two main types: the terrorists and and those the excuse makers. Okay, always have an excuse. So going back to the cannot pay, okay, because well, you see the top, we have two basic types of customers: the cannot pay and the will not pay. Okay, then when you're dealing with the cannot pay, you're looking at your temporary versus permanent situation. You have two basic options um, in terms of dealing with workout. Okay, so with working out, you either rehabilitate or you restructure a problem loan. Okay, um, so rehabilitate or deferment is short term. The goal is to stop the bleeding. It's like a band-aid. And if you restructure or modifying the loan, that's long term. You're trying to find a permanent cure. Okay, so that's the carrot. Okay, that's what they call using the carrot as opposed to using the stick. Okay, the second one is when you actually now go to liquidation, liquidating any assets or going after the customer. Okay, that's the stick. Okay, and your options are, and I put them in the form of safes, SAFES. Consider the various remedies. Um, you can you can have the client sell the asset him or herself or themselves, right? They can do it voluntary, or you could sell it as a lender, okay, by power of sale. Some items like government guaranteed homes, mortgages, you can't sell them by public tender. You have to go to public auction. Okay. You can appoint a receiver. You hear about things being put in receivership. Okay. There are legal implications in those. Normally, the receivership is you'll have an accounting firm will deal with that, or individuals who are receivers. You could go into foreclosure. You could enter into possession. You could sue on the covenant to repay. And I'm not going to get into any detail on those other than that liquidation is recovery either by realizing the collateral security or via other assets that the borrower, the guarantor. Okay, so just the main thought of that. So you have liquidation as your second alternative to um, to work out. Okay, so you either work out or you liquidate, right? Now, what you do have in your books is timelines for action, and this is why I said someone needs to be following up. You can't wait till 3 to 5 days for collections to be it's page 65, right? Uh, to wait for collections to follow up on it. If collections only delivered on the third day, fourth day, or fifth day, is important because within the first 5 days, if you don't get that payment, within the first 5 days, the further deterioration is more than likely inevitable. Now it's different if the customer says that I will make the payment in two weeks' time. They made a promise to pay. Okay, that's different because you've dealt with that, with day one, two, or three, and so they made a promise. So you don't expect that payment to be made for 2 weeks. But we're talking about not taking any action, not even calling the customer or looking internally, whatever it is. You cannot wait longer than that first 5 days to take some um, sort of concrete action. Okay. Um, so basically, what you're looking at is the first 1 to 5 days is determine whether the problem is internal or external. Again, if internally, resolve immediately or quickly. If external, you call the client. Between 6 to 29 days, you follow up with the client either by phone or letter or email. Okay. The next 30 to 59 days, you follow up with the client doing a site visit. And as I previously mentioned in another class, um, don't send a woman by herself. Don't send a man by himself. Send two people, one of which should be a man. In most cases, if you're doing any site visits, and it's um, possibly a confrontational client, get a police officer to go with you, or just let the police officers serve, or get a um, uh, someone to serve the summons or the letter on the client. Okay, site visits are dangerous when you're dealing with collection. Okay, now site visit, if you're just going you're annually reviewing a customer's account, it's a different kind of site visit. Okay, because you just going to the site and visiting and seeing how the company is performing. But this is site visits for collections. Okay, so you have to be careful. So 60 to 89 days, you want to have a written demand for payment. If no solid promises are being materialized, and then definitely 90 days and over, you want to have a final um, demand or final formal demand for full repayment of the debt. Okay. Any questions on that? Okay. So let's go to the next page. Pages 66 to 67. They have been updated. So I will arrange for those to be emailed to you. Okay. So pages 66 and 67 have been amended to one extent or the other. So, but the updates are included in this PowerPoint presentation in any event. Okay. Um, okay. So, the organization chart of the courts of justice system in the Bahamas. So I'm just going to I'll come back to the to those paragraphs. I just want to highlight here that we start off in the magistrate's court for any claims up to $5,000. Okay. So if you have a loan and so let's say you have a $7,000 loan, right? But you think only, you ain't gonna collect all that. Rather than spending a bunch of money in the Supreme Court, which is more expensive, take your chances in the magistrate's court because it's less expensive. Okay, so if you think you could collect up to 5,000 of that debt, go to the magistrate's court. Okay, any claims over 5,000, you'll go to the Supreme Court. Okay, if the Supreme Court does not rule in your favor, very seldom will the courts rule against the financial institution. In most cases, the courts will rule in your favor for straightforward cases. Okay. However, there are instances where um, we have screwed up, and so the client may have recourse, and they may take it to the Court of Appeal. Okay. We can also go to the Court of Appeal as a lender if we feel that we have a strong case where the judge ruled against us in the Supreme Court. However, we don't have that option in the magistrate's court. Okay, the only types of cases that can go from the magistrate's court to the Court of Appeal are in the case of indictable offenses. Okay, so if you're dealing with money matters, okay, bank matters in the magistrate court, you do not have the Court of Appeal to go to. Okay, indictable offenses are things like armed robbery, assault, rape, murder. Those are indictable offenses. Those can go to the Court of Appeal, but your money cases cannot go to the Court of Appeal. So if you have a $7,000 debt and you decide I'm going to the Supreme Court, the most I could get out of this is $5,000, right? Just bear in mind that if for some reason it's ruled against you, right, you cannot go to the Court of Appeal. Okay. From the Court of Appeal, if it goes against us or the client for that matter, there's recourse to the Privy Council, which is your last resort and is fairly expensive. Okay, so one of the things you want to do is you want to consider your costs. Going on to page 67, right? So you want to consider whether you want to carry the loan versus pursuing action to recover the costs associated with each. At the end of the day, what is the bank's overall cost or loss? Okay, there are opportunity costs to consider, legal and administrative costs, collateral cost considerations, and market reputation costs. So your opportunity costs are, do I move now or do I move later? Okay, do I take the opportunity to get this car now, go and collect this car now, or do I wait? And the longer you wait, you get depreciation or the person may write off the car. So you have to make a decision. So that's the opportunity costs. The legal and administrative costs, we touched on that a little bit in considering whether or not it is, you go one to the magistrate court or the Supreme Court, and secondly, whether it's worthwhile spending any money going after this client. Okay, because at some point in time, well, you already have one statement of affairs. That's when the loan was originally granted, right? But as you were doing follow with that customer, you should have called that customer in you should call them in and say, come, let's talk about this. And at that time, take a new statement of affairs. Okay, an updated statement of affairs. And then you could compare that statement of affairs with the original statement of affairs. Because on that statement of affairs, it'll show you what position they're at. So it may reveal that they have some assets now, right? Because they may have inherited something, so they have now property or whatever it is, right? Or stock shares that somebody left with them, or they may have acquired on their own, right? So if you have to go to court, you can say it's worthwhile when you're building your case to your head office or your manager or whomever, your managing director or president or whatever. You can say it's worthwhile us going to court because based on the latest statement of affairs, we see they own this and this, or we do not advise going because this person don't own nothing. They worse off than when they first came to us. Okay. And they now nearing retirement, they 60, and they're getting ready to retire any day now. Right. So we can't even go after them for any money they can get on the job. Okay. So well, in some cases, the pension ain't even enough to even help them, you know. Then, of course, there's your collateral cost considerations, okay? Um, and that is the collateral worth pursuing, right? Is it worth us spending money legally or otherwise to go after um, this collateral, right? Um, or are we gonna let's say for example, it's a car. The person owes us $10,000 on this car, but the car been broke down from can't hammer was a hatchet, and it's only worth $500. Okay, so is it worth spending $100 to send a towing truck to get that car? Okay, or maybe you may say, something, we go take it anyway and see what we can salvage for it because we don't want them to turn around and sell it for parts and get the money off it because it may be worth $500 like that. But if they sell individual parts, they get getting $1,000 to $2,000 selling individual parts. So you may do it, because you only want the customer to get the benefit. Okay, so you say, we might. But then again, if you collect it, you have to store it somewhere. What is the cost of the storage? Okay, so um, so what is the value of the collateral we're pursuing? Is it worth pursuing? Okay. Then of course there's the market reputation costs. Okay, those are the intangibles, right? So I know Miss Mary, she have terminal cancer. Um, Husband just get killed last week in, in one of the family islands of the tragic, right? Um, the son was murdered in college the week before, but we can still put out a house. Then Miss Susie or Miss Mary or whatever she is, she go on the news. Lord, I get terminal cancer. And the people put me on my house. I just buried my husband last week. My son get murdered. Okay, do you want that kind of stuff being said about you? Boy, that Biff Spank, they so uncaring. I wouldn't go. I can move my loan from them and go to so and so and so and so and take it somewhere else, right? Or I won't borrow now. Take my money out there, or whatever it is, right? Um, so market reputation costs. All right. So when we're considering the legal costs, legal and administrative costs, here are some things to bear in mind. If you're going pursuing the magistrate court, the fees are anywhere between $500 to $700. Okay, they're pretty much still the same. This 2016, 2017, but it's pretty much still the same. Demand letter, to issue a demand letter, the lawyer will charge you $75 per letter. Single court appearance, $300 plus. Um, then there's extra costs for having the client's means examined. If you have to, if clients say, I ain't got such and such, and you don't have the statement of affairs, then you have to examine the client's means. Then there's another set of money, right? And the hourly rate, I'll have to double check that to see if that has changed. The bar scale average is $200, $400 an hour. And then that depends on the seniority of the lawyer. Okay. So as you move up and you get those Keynes counsel, they don't come easy. They don't come cheap. Okay. I remember one particular person who was a Queen's counsel at the time. And he said his hourly rate was $1,000 or $2,000, something like that, right? And most of his clients were foreign clients. And he said if he had to take a plane to go and meet that client, from the time he left his house, he started clocking the time. That flight was delayed, too bad, too sad. That's an extra $1,000 per hour or whatever it was. He charged those clients. Okay, that man eventually became Chief Justice of the Bahamas. Recently retired, right? um, because we used to attend the same church, and we lived in the same area, and so sometimes I used to see him dashing down, Eastern Road, and he steering wheel and papers or dossier or file on the steering wheel or whatever. And I say, man, you be going that kind of speed and reading, right? So he explained to me, he's like, Glenn, what happened is, um, uh, you know, I charge my client from the time I leave home, right? So he says, so I be reviewing and blah, 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 blah. I charge him by the hour, right? He says, I need to maximize. I said, well, thank God. At that time, he had one of those big, it was not a Crown Victoria, but it was big like a Crown, Lincoln Continental. It was an old Lincoln Continental. It was a huge car, right? Back in the day, we used to call them iron donkeys because if they hit you, when they hit something, you finish. Okay, if that hit some of these cars nowadays, it'll ball up like foil paper. Okay, so so we say, well, thank God, at least you got that kind of protection. But then, what about pedestrians, other people, right? And he slowed down a bit in doing that, because I think I wasn't the only person who was mentioning it to him. He's like, by the way, so and so asked me the same thing and brought it to my attention. So, but some of these lawyers, depending on their seniority, the longer they've been um, in the business at the bar, the higher their fees are. Okay, so and that is why a lot of them, you may hear some of them in the past when they weren't made a Queen's Consul. It was called Queen's Consul when Queen Elizabeth was alive. They made noise, and in fact, one may have even taken the government to court over it, saying, how could they appoint so and so as the Queen's Consul? I've been at the bar and contributed more than that person. Because when you become a Queen's Consul and nowadays a King's Consul, right, you could really ask for a bunch of money. You could ask for money. Okay? So that helps you to jump. Okay? And that is why some of them too, they sit on the magistrate's court bench and then go back into practice because it ups their value. And so, because I know the system now, and I was once a magistrate, there's a certain respect that comes with a magistrate or a judge. Okay, so before I went there, I was charging you $200 an hour. Out now, I'm charging you $300 an hour, $500 an hour. Supreme Court claims over $5,000. The fees are between $1,500 and $1,700. That is to deal with a demand letter to judgment, and that in some cases you'll have to have an agreement with them. If not, some of them start at $5,000. And of course, there's extra costs for having the client's means examined. All right. So let's go back to talking about the judgment. Okay, page 66. Okay. A judgment is issued by the courts against the defendant for the value of the matter heard by the court. This could create difficulties with the individual securing a mortgage, purchasing a property, selling a property, inheriting a property, or willing a property to their estate. Okay, so buyer, seller, beneficiary. Okay, you could be, you could have difficulty. Judgments are uncovered during the title search of a property, or well, normally if someone's being granted a mortgage, the lawyer will do a title search, right? That is the title search, and the process also involves doing a search of the individuals. So the purchaser and the seller and the purchaser. Okay, so they will do a because they want to make sure that if the bank is doing a mortgage in a sales transaction, right? They want to make sure that the purchaser doesn't have any um, encumbrances against them, any judgments against them, and they also want to make especially sure that the seller doesn't have. Okay, that's their primary concern. So judgments are uncovered during the title search, and the purchaser of the property cannot, um, and the purchaser of the property cannot obtain title unless the judgment is settled. So if they come across a judgment, um, the, the client cannot that sale cannot proceed until they settle the judgment. Where the judgment is against the seller will have to settle the outstanding judgment before the property can change hands. The real estate transaction can only proceed if the judgment, and in many cases, any accrued interest as well, is settled. Okay. Sometimes the judgment creditor, that is the person who um, is the beneficiary of the judgment. Um, so that's a judgment creditor. The judgment debtor is a person against whom the judgment has been levied against, right? So the judgment creditor may sometimes settle for an amount less, right? So and it may not include any accrued interest if it's a loan. Okay, so if the judgment is say for $10,000, and they choose to accept $8,000, they'll be marked settled. So they can't go after that point. They can't go after them anymore for the $2,000 difference. Okay, once you agree that you're going to settle for 8 out of 10, the judgment is marked settled. Okay. Similarly, where the judgment is against the purchaser, the borrower, he, she, or they will have to settle the judgment prior to being able to take title to the property. Okay. In such instances as above, the lender could reserve the right to withdraw the earlier approval. Okay, so um, if the if we decide we can lend to somebody, right, and we find out that the person who is going to borrow the money from us to say buy a piece of property has a judgment outstanding against them, and it cannot, and they cannot settle it, then we can withdraw our approval because our approval was granted on the basis that they could take clear title. Okay, and even if they satisfy it, we can withdraw early approval because they did not disclose it when they were doing because a judgment is a debt. So you should have the client, the the applicant should have disclosed it. Okay, so the financial institution, the lender, can refute, can then rescind their approval, withdraw their approval. Okay. So note well, judgments expire after 60 years from the date the judgment was granted. Interest is accrued on judgments indefinitely. Okay, so while the principal sum remains the same, on the interest continues to accrue. There are no laws that stop the accrual of interest. Okay, where there's a judgment. All right. Any questions on that before we end with outlawry statute bar dates? No? Okay. So outlawry statute bar dates. Again, this section has been updated. So pages 66, 67. Well, first of all, you'll get, in the first going off, you'll get the PowerPoint presentation, but I will make sure that you get the amended pages. Okay. So outlawry dates or statute barred dates are the points in time when the lender can no longer pursue action to recover certain debts. The lender's ability to take recovery action through the courts ceases at the expiration of these dates. It is therefore essential, or very important, that lenders pay close attention to these expiration deadlines in order to prevent a debt from becoming uncollectible. Okay? I, in recent times, was contracted to assist a lender, and with their delinquency, their delinquency is one of the areas I looked at, and they did not pay attention to the outlawry dates and the statute bar dates, and so collectively, you looked at millions of dollars that they can go after those clients through the courts. They had to appeal to the only way they could do is now appeal to the human nature of the client. Come in and satisfy this debt, blah, blah, blah. Okay? So make sure you adhere to the deadlines in order to prevent a debt from becoming uncollectible. So here are some of the outlawry statute barred dates, how they apply. For loans and overdrafts, they expire 6 years after the date from the last payment. In the case of overdraft, a credit passing through the account, okay? Mortgages, where the document is under seal, that is uh, the document is under seal, and where good documented title has been given by attorney, it's 12 years after the date of the last payment. Okay, and then on excuse me, on judgments on mortgages, they are statute barred after 6 years from the date of the judgment. Judgments can be marked settled where the debt has been satisfied or settled. And remember the instance where I told you, if someone owes 10,000, but the financial institution, we accept 8,000, right? That's settled. Or we may settle for the full amount. Okay. Once it's settled, it's settled, and that can be before the expiration date, anytime before the expiration date. Okay, we can mark it settled, even if we accept a low amount. But once we accept the 8,000, that's the agreement that we reach with our client, notwithstanding that there's an expiration date, right? So let's say uh, a judgment expires in 2026, but we reach an agreement with the customer now to accept 8,000 out of the 10,000 remaining. We can't say, oh, well, we still have 2 more years or 3 more years to go, and so we can go after them for the $2,000. No, once you accept that's what the settlement is, right? Then you have to mark the case settled, okay? And it's recorded as being settled in the registry of records, okay? Any questions? Okay, we have 5 minutes to wrap up, which I don't need, unless you have any other questions. It's the end of chapter 11. Just a reminder, final exam, September the 7th, it's in person. For those in New Providence, it's here at BIFS. For the student in Freeport, the institute will send you to the testing center that they have arrangements with in Grand Bahama in Freeport. Okay, so that's it until Thursday, when we do the review. If you have any specific questions that you want, or specific things you want addressed on Thursday, you can send those to me by tomorrow. I would say by tomorrow, 7 p.m., the latest. so I can have sufficient time to um, prepare for the class because I want to incorporate it as in part of the PowerPoint presentation along with I already have. Your exam is pretty much set, and we'll talk about that in detail on Thursday. So the extent to which you can be in-house, it'll be good. But if not, um, uh, you should do just as well Thursday with a review class on Zoom. But um, it preferably is best in class um, for better um, for better reception. Okay, so that's it. Good night, everyone, and start your studying schedule. Start studying stuff. Okay.
You have my homework, the last homework.
Let's see. When I put the homework.